Good morning, everybody. Thank you for joining us. We appreciate you guys carving out time out of your busy days to be with us, and I look forward to an informative discussion on the upcoming election and the markets. My name is Adam Paoli, and I'm the founder and lead wealth planner of Coltiva Wealth Planning Partners. And allow me to welcome you to the latest in our series of webinars we are hosting to provide our clients and our friends with useful information about what's important now. Many of you know the team at Coltiva Wealth, and you know we remain passionate about educating people and helping people. Most of our waking hours are spent face-to-face or screen-to-screen with our clients, helping them establish goals that impact their finances and their families, and designing strategies to achieve those goals, and then executing them intelligently. And along the way, we're blessed to be able to build deep relationships with our clients, and we're passionate about helping them beyond the management of their investments as part of our process called the Path to Prosperity. And one important way we help our clients is to help them better understand what's going on in the markets, especially during times like these, where we're 27 days out from what has been a contentious election, to say the least. So to do so, I'm inviting a friend of our firm and a familiar face if you ever watch CNBC or read the Wall Street Journal. But before I introduce my guest, our guest today, quick housekeeping note: we will be accepting questions. Some of you provided some ahead of time, and we appreciate that. But it's not too late if you didn't. So if you'd like to answer questions, please do so. You'll find it at the bottom of the Zoom bar if you'd like to answer those questions. And we ask that you keep those PG and no name calling, please. So without further ado, our featured guest is going to be CFA Kara Murphy. She's the CIO of Kestra Investment Management, and she's here to share her investment expertise with us and specifically discuss the implications of the upcoming elections. So, Kara, good morning. Thanks for being with us.
Yeah, thanks for having me.
Well, let's jump into our first question. So, who are you going to vote for? No, I'm just kidding. A lot of the questions that came in from our clients were really policy-based, right? And why don't you spend some time talking about some of the major policy differences between the two candidates that are likely to impact the markets?
So it's interesting because we started off this year talking about this election as, in some ways, one of the lowest political risk elections, and people had a little bit of trouble understanding why. But it was because, at least up until this summer, we had two candidates who had previously served as president, which meant that we had a pretty good sense of what they would be like in office, who they would surround themselves with, which policy initiatives they would really lean into. And what the market hates the most is uncertainty. So as long as you have two relatively certain outcomes, the market's going to be a lot more comfortable with that. Of course, all that got upended in August when Biden stepped down. Harris became the nominee. Very late entrant into the political arena when it, relative to other presidential elections that we've had. And she'd been like relatively unknown, I would say, even though she served as vice president, wasn't terribly out in the public eye. So what that means is that when we get down to policy, even though we had had a presidential election that had been going on for a very long time and we had had two candidates stumping, it was only very recently that we've gotten into some more specifics in terms of their policy proposals. And I would argue even now, this election has been relatively policy light compared to previous runs. And we've actually tried to find a way to quantify it, and it's been a little difficult to be able to do. But simply when you look at, say, like Reagan Bush, those presidential elections were ones that were like heavily run on policy. So all that said, we do have some policy, right? And so some of the biggest differences are tax regimes, where we have the tax cuts that were put in place under Trump a number of years ago that are due to expire. I would say, like, even though that's a big difference between the two candidates, there is general acceptance of some of those tax policies being kept lower than pre-Trump. Harris has been very careful to sort of carve out middle and lower income individuals to be exempt from some of those tax rate cuts increasing, or tax rates increasing, and has tried to really shift that towards higher incomes and corporations. Trump, I think, has been more protective of corporate tax rates and actually arguing to lower them overall. So that's one where we've seen a pretty good set of differences. But then there are other things like tax on tips, where we've seen two candidates who have been relatively supportive. And then the other like sort of like big bucket of items that I would mention is on regulation. And that's where there's a fairly clear difference between the two candidates, where Trump has been very supportive of rolling back regulations. Harris has indicated, again, without a lot of specifics, but has indicated she would lean into more regulation in certain areas. And it's interesting because I happened to be on Capitol Hill just a couple of weeks ago, meeting with legislators. And there was this sense, anytime we sort of touched on regulatory issues, there was this sense that where it was like, it's not even worth talking about until we know who's in the White House, because it will be a big change depending on who gets in there.
Understood. And I appreciate you highlighting those differences. And in terms of, taxation, obviously, like you said, it really does depend who gets into the presidency. But, we know it's very likely that if nothing's done, those tax cuts are going to roll off. But how do you think, economically, how do we think the markets are going to respond to the differences, specifically in taxation?
So this is a tricky one, partly because there's a big difference between what a candidate says they're going to promote from a tax policy perspective and what they can actually get done. And so what they can actually get done will depend heavily on what the makeup of Congress is, which is still very much a question. We have the presidential election that's razor thin, we have the House that's razor thin, and we have the Senate that's tight, I would say. So it's not clear, even if we can determine who's in the White House, how much support they'll have once they get to Congress. I think regardless of which party ends up in power, it will be a relatively slim majority in both houses. I feel like that's like a fairly safe prediction to make, which means that any of these more controversial tax policies are going to be significantly watered down once they actually get through. So then as we think about market impact, I would guess that the market impact is going to be fairly muted because any tax policy is going to have to be fairly muted. The one that tends to move the market the most in the short term are corporate tax rates. And so we saw when Trump first initiated the lower corporate tax rate a number of years ago, you saw the market fairly quickly move up to accommodate for that lower tax rate, right? Because suddenly those earnings fell to the bottom line. More earnings power means that investors are willing to pay more for those stocks. So that would be the one that I would look at in the most near term. But I would argue that also a lot of those, so let's say tax rates go down, stocks jump up by that amount. I would argue that over time that effect sort of fades. And although it's like a one-time sort of near-term benefit, it doesn't really last for all that long.
Understood. And there's also been lots of discussion on tariffs as we talk about the differences in policies, and that certainly got a lot of folks' attention because of the economic impact that can have. Can you talk about the impact that each one of the candidates has proposed regarding tariffs, and what Kestra's thinking about that?
Yeah, it's a good one. So if you don't mind, I will share a graphic that we have. We've had to like put together a bunch of graphics to keep track of all this stuff.
No,
So
please do.
let me just share this. But I found this was sort of helpful in keeping track of everything. So similar to the tax cuts, tariffs is an area where there's actually like a decent amount of overlap between the two candidates. And I would say presumed overlap because Harris actually hasn't talked very much about tariffs. But if you assume that she's going to sort of pick up what the Biden approach was, we can assume that a lot of the tariffs that were implemented during Trump's tenure were continued under Biden's tenure, and we would presume that Harris would also continue with some of those. So the biggest difference between what we're calling here Trump 2.0 is that Trump had said if he gets reelected, he'll increase tariffs significantly more. Whereas the assumption is that if Harris gets elected, those tariffs are continued and or made a little bit more targeted. So here we have, a number of different specific ones that they have highlighted. And so I'll highlight in the bottom of the blue column there are tariffs on medical products. So syringes, oh, we have a misspelling there. So syringes and needles, and then PPE. So this is a great example of a very targeted proposal that's meant to sort of protect national production of things that are considered really essential. And this came up during COVID, so it wouldn't have been sort of thought of when Trump was initially elected, but has since become deemed important. When COVID happened, we found that we didn't have enough of our own locally made syringes or face masks, right? So this is where tariffs are being very specifically targeted to kind of protect the national industry. If you look over on the right, you'll see, 10% baseline tariff on all imports. Whereas Harris is being very targeted in these tariffs, Trump is actually widening the lens and saying, okay, so we think tariffs have worked really well to do what we want them to. So we're going to protect all U.S. industry and all U.S. manufactured goods by imposing a 10% tariff on everything. And then you'll see there that second line, 60% tariff on all Chinese imports. So this is a very political thing. This is not necessarily protecting certain U.S. industries. It's really about making a political statement saying, China, we don't trust you. We're going to deem you as a sort of trade enemy and make it very difficult for you to sell into our market.
Yeah, certainly two very different approaches to a topic, and one that's been growing over time in terms of presidential use of tariffs. So we appreciate the clarification on that. Let's talk a little bit about the deficit. As we have conversations with clients, I think, frankly, I've been in the business 20 years now, and deficit has been part of the discussion for almost all of it. As you look at these two candidates, do you think that either of them are going to meaningfully address the growing deficit?
The short answer is no. And so I often describe the deficit as an American problem, not a political problem. And if you don't mind, I'll share a couple charts on this too, because I think this is where feelings get very heated, and it's helpful to actually look at the data. And I'll also qualify this by saying, I've been in this business for a long time too, and I've been asked this question many, many times. And only in the last couple of years, so for many years, the answer was, yes, the deficit is increasing, but it doesn't keep me up at night. And that's because even though the deficit relative to the size of the economy has been growing, the amount that we pay on our debt has actually declined. So the highest proportion of GDP that we spent on our debt peaked in the 1960s, and it troughed just a couple of years ago. And that's largely because interest rates have come down. Now, as we all know, over the last couple of years, interest rates have come up. So the cost of paying off that debt has increased. If that continues, right, if interest rates don't come down, and if our debt does not come down, the amount that we're going to spend on that debt is going to go up, right? So all of a sudden, we went from it not being an issue for many, many years to it being an issue. And this is where I think it's worth kind of spending a little bit more time on. So let me show you this slide. So this is looking at the increase in the national debt by administration. So what you'll see here is, beginning with Truman, every single president has increased the debt on a dollar basis, right? I mean, you look at this again, like debt is not a party problem. This is an American problem. We like to spend money, so does everybody. But because interest rates have been so low, we've been able to borrow money very easily. And so we've been able to sort of fund this additional spending very, very cheaply. And then if we also look at it, this is looking at debt by dollar. If you look at it relative to the size of the economy, you can also see pretty much since Truman, it's increased relative to GDP in nearly every administration. During those times when it took a big step down, so I'll point over on the right towards the global financial crisis in 2008 and 9, and then during COVID. So those are very specific, I would argue, national emergencies where the government said, okay, there is something really big happening here that we have to respond to. So they really ramped up spending. And you can see where they backed off, they pulled back on spending as we came out of the financial crisis, and then again, as we came out of COVID. But we're still at a really high level of deficit to GDP. And so here we look at, we talk about the biggest loser in this election is the deficit. And we actually argue, is it the biggest loser or the biggest winner? Because kind of no matter who gets in office, the deficit is probably going to increase. So here we look at the deficit relative to the overall economy and how it's projected out. So what we've been looking at before are historical numbers. This is looking out into the future. So the blue bar is assuming that the tax cuts that Trump initiated expire, right? So tax rates go up. So you can see that the deficit relative to GDP remains pretty high going out about 10 years. If the tax cuts that were initiated under Trump stay, then you add on that sort of like cream colored bar on top. And then if you think about like what the government actually spends money on, the amount of dollars that are spent that the government actually has control over, or what is considered discretionary, is fairly small. So the vast majority of US government spending is spent on things like Social Security and Medicare and Medicaid, things that both parties have said they're not going to touch. Well, okay, if we take them at their word, and I understand why, right? Because they would get voted out if anybody says that they're going to start rolling back Social Security benefits. But what that means is that they're left with a very small sliver of spending with which to work. And it makes it really, really hard to bring down this excess spending when you're only dealing with a very small part of the budget. So what that means is it's going to be tough for any candidate to come in and really make a meaningful dent in the deficit.
Yeah, and you brought up Social Security. We actually had a question that jumped in that we'll throw that in since we're here and we're talking about it. Can you talk a little bit about Social Security? We've got a lot of clients who are in or near retirement, and Social Security is certainly an important portion of their retirement income. There's been a lot of talk, and for a long time, about the shortfalls in Social Security, and a lot of the campaign promises have been, as you said, nobody wants to touch Social Security, but in terms of, there's not been a lot of meat behind what we're going to do to address Social Security. And the question specifically referenced, President Trump's going to try to inspire growth to help cover that, but that doesn't provide a lot of details to how that happens. So can you talk about what are the things that either one of these candidates can do that could potentially help the Social Security funding issue?
Yeah, it's a really good question. And this is, at the heart of this really intractable problem. So we've known for a long time that Social Security is not self-funding, right? It can't sort of continue to sustain. So some easy ways to try and address the issue and not tinker with benefits that are being paid out right now is to slowly start to increase the retirement age. And we've seen other countries do this, where you say, okay, we're going to keep the existing retirement age where it is for 10 years. But 10 years from now, let's say you add a year, and every couple of years you add another year. So again, if I could wave a magic wand, I would recommend that we start taking those sort of like less contentious decisions now without impacting people immediately and saying, okay, it's not going to take effect for a long time, but at least you start to put in place some things that help the issue. But like the fact is, we have this big demographic issue where we have a very aging population. We're very fortunate that it's less so than areas like Japan and Europe, but we do have a very aging population. And unless you have some significant growth in the labor force, you just don't have enough people who are paying in order to support the retirees. So either you have to grow the labor force, or you have to start to chip away at those benefits going forward. And I would argue you just start now, even if it's just very small ways to be able to do it so that you have less of a problem to address in the future.
Yes, I'm personally not planning to get Social Security until I'm 80. I think that's likely where this is going to land, and
Same here.
We'll see how that shakes out. So let's talk a little bit more about on the economic side of things. There's been a lot of talk over the last really 2 years about recessionary pressures and a soft landing. And so as we look at these candidates and some of the policies that might enter in, like as you said, either with obviously a change in presidency and or with the House and the Senate, what do you think are some of the biggest risks that could come out of policy that would prevent a soft landing, if any?
So, I grew up in the industry with this idea of don't fight the Fed. And that's simply because the Federal Reserve and their setting of interest rates has a disproportionately large impact on the economy. It is a very identifiable policy change that we know can also really impact economic growth. And the Fed is meant to be independent, right? So they should be unaffected by what happens in the White House or in Congress. But I mention that because it is really, really important, and there's a reason why investors like myself spend so much time thinking about the Fed. So one thing I would say is I think it's really important that the Fed sort of maintains that independence. And there are certainly some politicians who would like to see that go away, who would like to see the Fed be more receptive to political arguments. I think for the long-term stability of the economy, the Fed it's really important to sort of keep independent. And their ability to sort of navigate, you mentioned like a soft landing or whatever that might be, to navigate sort of peeling back interest rates, start to lower them, give the economy a little bit more room. That will be the most impactful thing for the economy. And so far, things look pretty good. So when we look at the overall economy, we're starting to see, inflation has certainly subsided. We are near the Fed's long-term goal. The job market has started to loosen up a little bit. Manufacturing is still, I would say, in neutral. We haven't really seen manufacturing activity start to pick back up again, but corporate margins look pretty healthy. So those are a number of different things that we look at to suggest that the economy is actually in pretty good shape. The other thing I'll mention is consumers who continue to spend a little bit less than what we've seen over the last couple of years. Consumers are saying they don't feel very good about the economy, but they're acting like they feel pretty good. So again, all of that to suggest that the economy has slowed, but in a sort of healthy way, in a way that supports overall lower inflation. And I think, then when we think about sort of like individual candidates' impact on the trajectory of the economy, I always like to sort of downgrade people's expectations. And the actual candidate who ends up in the White House actually has very little impact on the near-term trajectory of the economy. Now, it's very important who ends up in the White House, right? And I never want to discourage anybody from voting because there are a lot of things that get determined by whoever ends up in there. But any one individual's ability to sort of steer the economy left or right or whatever it might be is very, very limited. I mentioned the Fed because they have tentacles, because they control interest rates, they reach so many different areas of the economy. But the actual individual in the White House just doesn't have that kind of power. And I say that with also the belief that that's a wonderful thing about being in America, is that we have these really strong institutions that provide continuity from one party to the next, from one administration to the next. And that is a great thing. I was just listening to the news this morning, and the new Mexican president has been inaugurated, and she has a whole host of things that are going to be impacted by her. She will have a great, like a very large impact on Mexico. But that's because Mexico is a less stable government. So I think we should be proud of the fact that whoever we elect into Washington is only going to have a limited impact on what it is. But certainly we talked about taxes. We talked about some other investment proposals, which can have a big impact on certain industries and certain localities. So the Biden administration, and presumably Harris would pick this up, has had a big impact on infrastructure, has been looking a lot at rebuilding different forms of infrastructure. And we've seen that kind of roll through in things like construction companies, concrete companies, engineering companies. That would likely continue. Trump has had a number of policies supporting enterprise zones and trying to draw in investment dollars there. So there are some areas like that would be a little bit more focused on particular industries or locales, depending on who gets elected.
Yeah, I appreciate that insight. And one thing many of our clients have heard me say is I believe that politicians think they're way more important than everybody else thinks they are. And,
I love that. It's great. And you know what? Let me just share. I had a call with a policy expert. I think it was last week, and I wrote down this quote because I love it. And he said, this is not a great country because we all agree with each other. And you and I were talking about this beforehand. Like the ability for us to be able to argue about this stuff is a wonderful thing. But as you said, it doesn't mean that whatever that person says is going to get implemented.
Yeah, exactly right. Well, I want to talk a little bit more about unemployment because you mentioned that both when we talked about Social Security and one of the potential ways to help that problem is to strengthen the labor market, as well as the impact that it's having on inflation. And we've been in this circle where good news is bad and bad news is good, especially when it comes to unemployment. And you mentioned that we are seeing the unemployment rate increase. Are you and your team concerned about a weakening labor market and what that's going to do to the economy?
Yeah, so this is such a good question. We spend a lot of time kind of looking at labor market indicators. So let me provide a little bit of perspective. As we look at, let's just take like the unemployment rate. There are a lot of different ways of slicing and dicing the market, but the unemployment rate just looks at the number of people who are not working relative to the number of people who are in the labor market overall. And actually, I should say the unemployment rate looks at people who are not working and who are looking for work. So it's a distinction. That we have other measures of sort of capturing people who've dropped out of the labor force and sort of given up. But if we just use that straight up most commonly cited unemployment rate and we look at it relative to history, today's labor unemployment rate is among the lowest that we've seen since the 1960s. So when we think about like health of the labor market, jobs are plentiful overall. Now, there might be areas of the market where it's still difficult for certain people with certain skills to find jobs, right? So this doesn't mean that anybody can find a job. It's just in aggregate, when we look at the labor market, there are more jobs available than we've seen in 90% of all the periods that we've looked at going back to 1950s. So in that sense, the labor market is quite healthy. We've also seen significant wage gains. When we adjust that for inflation, they're less impressive, but wages have been increasing at a fairly healthy clip. Over the last like 6 months, what we've started to see is the unemployment rate has started to rise. It is still in a place that by any historical measure would be considered very, very healthy. But it's the movement that has people a little worried. Because what happens is that the labor market is often sort of the last piece of the economy that moves. So, more recently, the Fed started raising interest rates about a year and a half ago, and different parts of the economy started to slow. And the labor market really only started to slow like 6 months ago. So now the Fed is starting to cut interest rates. The question is, does the labor market continue to slow or does it sort of even out there? And that's the part that's sort of the art around policymaking. And so we're watching it very closely. We would expect that unemployment rate would rise further, but not necessarily get into real trouble unless there's some big catalyst. And so, some of the other ones that we look at are unemployment claims. Those numbers come a lot more frequently, so we can kind of see what's happening. And again, those are suggestive of the fact that the labor market will continue to loosen, but not necessarily go into trouble territory.
Understood. We talked about a lot of the topics that have been mostly headline topics, right? With tariffs and taxation and labor markets. What is one big thing that you guys are currently studying, talking about at Kestra in terms of the economy that most people aren't considering?
So, I mean, one thing you didn't mention in your list is corporate earnings. So, as investors, that's one that's really important to us and doesn't always make the headlines. But that is, probably the single most important factor in sort of supporting U.S. stock markets. And as we look at sort of where that has gone, so let's go back to 2023. I mentioned as the Fed raised interest rates, there were certain areas of the economy that responded very quickly and started to weaken. Corporate profits was one of those. So peak to trough, we actually saw a decline in corporate profits of about 9%. That's actually consistent with a mild recession. So I would argue that there were certain areas of the economy, including in corporate area, that experienced a mild recession. Manufacturing is another area. But by second or third quarter of 2023, we started to see those earnings bottom, and they've come back up off the ground. When we dig a little bit deeper to identify where corporate earnings have been strong, the strongest corporate earnings have been in, those high growth tech companies. So think like folks may have heard the term Magnificent Seven. Those were companies, largely because of the AI boom, but for other reasons as well, really started to see corporate earnings tick up significantly in the second half of 2023. In 2024, we've continued to see really strong growth among a lot of those companies. But going forward, the question is, will that continue, right? Will corporate earnings growth and strength be concentrated in just those names, or will it start to widen out into other areas? So I'll give the example of small cap names. So smaller companies are still in earnings recession. So we really haven't seen a pickup in earnings in those names. But over the next couple of quarters, the expectation is that we start to see earnings growth there. With the Fed cutting interest rates, we would expect that some of that momentum in the market, maybe we won't see quite as strong growth among things like the Magnificent Seven, but we'll start to see stronger growth among small names. And so we start to see the market favor some of those other smaller names.
Yeah, we've been having lots of conversations about the importance of the diversification in classes like small caps and mid caps and other places.
So
to your point, that have not seen the recovery from 2022 that large cap growth has seen, and I think it's been very easy for people to get lulled to sleep by what the S&P 500 has done. But moving forward, we certainly have concern that they're going to be able to keep that earnings pace, whereas there's lots of other opportunities and some other less publicized portions of the market. So let's jump into just kind of more outlook question, but just regardless of who's going to win this election, if you look at where we sit today, we're in this decreasing interest rate environment, and if you go back since 2008, just to name the S&P, look back at year-over-year returns, we've had a lot of really good terms, a really, really long time, really excluding 2022. So do you think that as we go into 2025, that stocks can continue this run of double-digit returns, and maybe just give us your total overall outlook for 2025?
Yeah, it's a good question because we have had a really remarkable market environment overall. And you mentioned 2022 when we had a bear market, but let's not forget 2020 where it was a bear market in like a gut-wrenchingly short period of time. And it's easy to sort of forget that because it was so quick, but corporate earnings really took a big step back. 2022 for sure. We had the Magnificent Seven, for instance, in 2022, we're down 50%. Like those stocks really took a huge hit. So, building on what I said earlier, looking out to 2025, I think it all really depends on American companies' ability to continue to earn. And that's been a huge difference, I think, in this very strong market relative to, say, 2000. So, there are some similarities in that in 2000 and today, it was very much driven by a new technology. In 2000, it was the internet. Today, it's AI. And you had a handful of companies that were sort of at the forefront of adoption and leveraging this new technology. And it was a fairly concentrated area of the market. So those are the similarities. The difference is that if we look at 2000, a lot of those names, many of them didn't generate any earnings. But there wasn't nearly the earnings power that you had in 2000 that you have today. And so I think because of that, there's a lot more support for what many of these names have done. Now, if you look at overall valuations, they have gotten much richer in certain areas of the economy. And that's why we would look at, to your point of diversification, it's so important to remember that there are a lot of other stocks in the ocean, right? There are a lot of other names that haven't yet had the benefit of an earnings recovery, and we think they will, particularly as the Fed continues to cut interest rates. So if you have an overall, strong economy, not too strong, not too weak, but a good growing economy, then some of those smaller names will have lower interest rates. Those smaller names are often much more heavily reliant on debt. So that debt becomes less expensive. That kind of falls right to the bottom line. So I think as you start to have that happen, you can have a very strong market, but it'll look a little bit different than what we have seen over the last 18 months.
Very good. I appreciate that. Well, we have a couple more questions from the audience, and just want to throw a reminder to get your last few questions in. On the topic of AI, you brought up AI and obviously the impact that it's had both in 2023 and 2024 on the markets. Talk to me about how you see AI shaping the market. Does it just really stick to tech? Does it go beyond tech? And you also brought up the similarities to 2000. Do you also you somewhat touched on this in terms of some companies with earnings, but do you believe a bubble is created similar to what we saw in 2000?
I think it's a really important question. It's one that we think about a lot. And so a couple things. One is I started in the business almost to the day that the NASDAQ peaked in 2000. So I spent like my first couple years being like, oh my gosh, these stocks are falling every day. And at that time, there was this sense that the internet was going to revolutionize things. And they were right? It has. We use the internet like minimum 50 times a day, probably. And it has revolutionized how we bank, how we shop, how we communicate, how we drive, right? It has completely revolutionized how we do things. But being able to pick the winners in like 1999 was extraordinarily difficult. And many of those names that were seen at the forefront of developing the internet or accessing the internet are now out of business. With AI, I think it's fairly similar in that, my kids will work very differently because of AI. My son, had talked about wanting to be an accountant, and he's probably right in that he was like, you know what, I don't know that accountants will do the same kind of things that they used to, and he's right. So their work will be very different, but identifying the companies that are around today that will benefit from that 10, 20 years out is really hard to do. So what I would say is, I think the long-term impact on AI will be different companies and different individuals' ability to leverage this technology to do what they do, but do better. So take accountants, for instance. We will still need accountants. AI will probably be able to do an awful lot of work that used to be done manually. But you're still going to need a person to be able to oversee that and be able to interpret it and talk with people and explain it and make sure it's correct. So it'll just be done differently. And firms and individuals who can figure out how to do that and how to really leverage it will be helpful. So what that means is that I think it'll be a little bit easier to identify certain industries that will benefit and sort of think about the overall productivity benefit for the broad economy as opposed to picking individual companies.
Yeah, that continues to be a difficult conversation, and we do see several individual companies doing well. But yeah, the question of does that continue, and are they the ones to harness that? I think of my AOL.com clients who still are holding on to those email addresses. That there will be winners and there will be losers, and it's important to know that we shouldn't be staking our financial futures on any one of those individual names.
Can I give one more example that I think is so interesting? I love the AOL one because I still have a clipping of like when AOL bought Time Warner. I mean, it's like hard to fathom today. But when I started my career in 2000 at Morgan Stanley, and at the time, we had this massive investment department with all these different analysts and teams and whatnot. At the time, we had 3 different technology teams, not just like large cap, but like specifically on technology, 3 separate teams, each doing their own research, picking their own stocks with different portfolios. Collectively, those 3 funds went down 95% from the peak to the trough. Think about that. These are some of the smartest people on Wall Street who didn't have groupthink, right? Because they were separate teams and they were doing all their own stuff, and they all went down 95%. So those folks couldn't pick who the couple winners were going to be over that time period. And so I don't know who the ones are going to be who aren't going to be able to make the next cut, but that diversification is what will help you not get stuck, right, with those couple names that aren't going to make it.
Yeah, not chasing the previous winners only to fall short.
Yes.
Thanks for sharing that story, and yeah, you'll be glad to know that we do not have 3 all tech funds in our portfolio, so we will not be suffering a similar fate.
That's good.
Another question that came in was on immigration, and obviously it's a touchy subject, but certainly has some potential economic impacts. And I know you mentioned earlier that a lot of what is being campaigned is unlikely to, come into fruition, but there's been a lot of talk about mass deportations and what that might do to the labor market. So can you speak to a little bit to what you guys are seeing and studying in terms of immigration and how that's going to potentially impact things economically?
Yeah, and it's funny because folks in my position sometimes like to avoid the real political topics, and you can guess why. But immigration has become one that has become so important to the labor market story that what we have found is that a lot of firms have started to talk about it reluctantly because it is so impactful. So we touched on Social Security as one example of the demographic challenge that we have, and that we have a very aging population. We have an enormous number of people who are retiring right now, coming out of the labor force, looking to draw on their Social Security benefits. When you have fewer new young workers coming in, that becomes a real challenge for a lot of different reasons. You don't have enough workers. You don't have enough productivity sort of helping to grow the economy, and you don't have enough people paying in to Social Security to support those who are retiring. Over the last couple of years, we have had a higher amount of immigration than what we typically have. And again, like we can look at the numbers. The numbers are clear that there have been more individuals entering the workforce. We have always, in the US, we've always had a significant number of individuals who, of workers who were born abroad, right? So that's the sort of metric that we look at to see which immigrants are in the labor force. Because of the way that most people have been entering the US over the last couple of years is through asylum. It means that generally speaking, 6 months after entering the US, they're illegal to work. So then they can get paid on the books, and they're actually paying into Social Security and other types of taxes. And so what that means is that it's helping to bolster those funds. So we've had a larger number of workers. Those people tend to take lower paying jobs in general, but they're still paying into Social Security in the same way. So they've created this like kind of looser effect in the labor market, and they've also helped shore up some of the finances that support Social Security. Now, if you look to unwind that, then you have the opposite impact, right? So if we're going to start deporting large numbers of people, you're going to pull them out of the workforce. So it means that you have fewer workers relative to jobs, and then you have fewer people who are paying into Social Security. Now, depending on where you are on the political spectrum, you might think that that is worth it, right? So you might believe that you're willing to take that economic impact for the political impact. I'll let individuals on this call determine where they land on that, but simply the math of number, like just the math associated with it, if you have fewer workers, you're going to have fewer people to take jobs, and you're going to have fewer people banging into these things. I would say the other thing where local communities have really struggled is the near-term impact. And I don't want to dismiss this because this is like a real political, social, and economic impact. There's a real near-term impact when you have immigrants who are coming into the US, and sometimes in fairly close quarters, and being able to successfully integrate them takes time and it takes resources. And so again, that's the trade-off, where ultimately those people tend to find themselves into jobs and contributing to the labor force, but there is a really real like near-term impact for those communities who tend to be more heavily impacted than others.
Yeah, no, it's a very difficult topic, very many layers to it, and we're certainly not
Yes.
going to solve that on this call. But yeah, it's not necessarily as cut and dry as it's good or it's bad, like many of the other topics on this call. Well, we're getting to the end of our time together, Kara. Is there anything else that you want to share for our clients who this election is keeping up at night and starting Facebook fights with their friends? Anything else that you would like to,
Okay,
any
well,
pearls of wisdom you'd like to share?
So first of all, stay off of social media. So that's a good start. But the other thing I would say, again, like we've looked at this 100 Ways to Sunday. The impact of a presidential election on the markets is very short-lived. And often the market tends to react before the election actually happens. So that, let's say, for instance, you're really worried about the market and you sell out of your stocks and you're like, I'm just going to wait this out. Often the market starts to rebound before the election even happens. And usually looking back 6 months from now, you can't even tell that it happened. So what will drive the market over the long term are the things that we've talked about: the overall economy, what's happening in the labor market, corporate earnings. Those are the things that drive the market over the long term. And whoever sits in the White House will not be the determinant of where the market goes. And I hope that helps people sleep a little bit easier at night. I know I try to remind myself that because it is a trepidatious time.
Yeah, no, and it's difficult, right? When, as you said, on social media and lots of other media outlets, you can't seem to avoid some of the news on this. So it seems like it's a little overwhelming and probably more important than the actual outcome will be. And so we appreciate you, Kara, taking this time to lend us your expertise and your time and help our clients to sleep better at night. And like our clients, I'm sure that you'll be very thankful when these 27 days are over and we get back to talking about things like earnings and things that are a little bit less, gonna get people anxious and riled up. So, Kara, thank you very much for spending this time with us. And ladies and gentlemen, we really thank you again for taking your time to be with us today. We hope you found this to be helpful and find comfort knowing that your team here at Coltiva Wealth is here for you. And we're available to discuss these things that are keeping you up at night, because our goal is to continue to do whatever it takes to help you look to your future with anticipation instead of anxiety. So please don't hesitate to reach out to us if you have any additional questions that weren't answered here. We're glad to be a sounding board to you and your family and those you care about. So we pray you stay well, and we hope to see you guys soon. Kara, thanks again for being with us.
Thank you so much. Take care.
All right, have a great day.